Hello YouTube, this is Crazy Trader with your favorite stock review, and I'm here again. Let's see how today goes. I'm on, we are still doing our 5 read stocks that I think every Gen Z and millennial should have, and I already did 3 stocks, and the last 2 were supposed to be MFA and IVR, but I've done a lot of videos analyzing or reviewing MFA and IVR. So I chose 2 different stocks to review on, because there are a lot of great stocks out there that I believe are also doing really good and that people should look at. Okay, if you don't have any mortgage REIT stocks, or if you don't have any REIT stocks, these are some of the stocks that you should look at, and there are some good dividends. These guys are paying some good dividends, and if you can take a little bit of risk, I think you can get some good dividends out of these guys. Even if it's just for a year, you can get the dividends and then move it to somewhere else. So let's look at the stock, and the stock that I'm going to talk about today is ORC. That's the ticker symbol. The ticker symbol is ORC, but the name of the stock is Orchard Island Capital. And Orchard Island Capital is a strange stock. Okay, there are some risk associated with the stocks. I'm not going to lie to you, but there are some risk, but there are some also great benefits if you can overlook the risk. So if you can see, the stock itself doesn't move. It's not too volatile. I personally think it's not too volatile. If you can see, look at that. It's not moving up. It's not moving down. It's just kind of bouncing sideways and sideways. Even in the past year, look at it, just 5% down. It's really bouncing up and down, sideways. Not up and down, but sideways for a long time. In the past 5 years, you can see, I think you can see a little bit of a consistent decline, but then it levels out at 6, 5, 6. You look at that, 5, 6. 5, 6, and before the pandemic it was at 669. Okay, so it's been like that from 2019. It's been leveling around 5, 6, and then right after the pandemic, right when the pandemic hit, I think it dropped to like $2 36 cents. That was the bottom, $2 36 cents, and then it from there, and I think it has risen a little bit all the way to $5, which makes some sense. Okay, so let's go. Let me just take you down, and it was founded in 2010. So market cap is 621 million. Very pretty small company, not a big one. And then let's go. I found an article that I think you should be interested in. I'll read it out to you, just a few paragraphs, and then you can see what I'm talking about. It has its own risk. So here's a paragraph 1 says, so here's a Florida-based operation operated by Bimini Advisors that says it will pay you about 15% a year for your money, which it will then invest in a package security in the volatile residential housing market. So this might cause you to roll your eyes, but the thing is that Orchard Island Capital is a perfectly legitimate mortgage REIT that trades on the New York Stock Exchange and has been paying dividends every month since March 2013. So if you can see, this company has been paying dividends every month since March 2013. That's 8 years now. Solidly, they've been paying dividends every month for 8 years, 8 solid years. So you can see that they have the foundation for it. They've done it. They have the framework for it. It's not something that they don't do. They have been doing it for a while now. And as you can see, the article says the 15% a year might cause you to roll your eyes, and that's true. If 15% is a lot, for a stock to be giving you 15% a year, I think it's a lot. This is the first 15% stock that I'm seeing so far, and I think I've reviewed a lot of stock. This is the first 15% stock that I'm reviewing as of now. Okay, I have never reviewed a 15% stock before, so this is the first one, and I want to show you something. There's also a risk associated to it. Okay, let me read. In the middle of this third paragraph, I'll read it out to you. Keep an eye out here for the impulse to chase yield, and be ready to bail out if you think the interest rates and the housing markets are heading north or south respectively. Okay, so if you think the housing market is becoming fishy, you have to run away from the stock. You have to just bail out, take your money out, and move into something else, because the kind of interest rate, the kind of dividends that they are giving out, that means they are taking a lot of risk. They are taking a lot of risk, and then you have to get out of it if the housing market gets fishy. So I'll read out the last paragraph to you. Orchard Island shares closed at $5 on September 28th, compared to its 52-week high of $6.2. So it closed at $5, and now let me see how much it's at. It's at 5 point something. 5.01, which is also, I mean, pretty decent. Okay, let's go straight to nasdaq.com, because I really want to make this quick. Look at the dividend yield. The dividend yield is 15.69, let's say 15.7% a year. That's a lot. This is the first 15% dividend stock that I'm reviewing. I've reviewed a lot of stocks, you guys know. So this is the first one. So this dividend is really huge. And if you want some drip effect, you can put some money in here. If you can go with a lot of risk, this is a place that you can put a lot of money and get your 15%. By the end of the day, you can just do it for 1 year, get 15%, and take your money out and go somewhere else. The annual dividend is 78 cents. That's almost $1. Okay, almost just 22 cents short of $1, 78 cents for every stock that you hold. So it makes a lot of sense personally to me. And they are paying 6 cents dividends. Okay, 6 cents dividends every month. Every month, technically, so they are paying 19 cents every quarter. Every quarter they are paying almost 20 cents every quarter. Okay, 20 cents every, let's say 20 cents every quarter. That's a lot in dividends for a $5 stock, and they've been doing it for a long time. If you can see, they as soon as the pandemic hit, they dropped their dividend from 8 cents per share to 5 cents per share. And then they did 5 cents per share, and then they hit it on 6 cents per share. And then the 6 cents per share, they maintained it from August all the way to now. They've maintained it for a very long time, even right after the pandemic. These guys weren't hit too much. I don't know what kind of risk they are taking, but they are taking some good risk, and it's paying off really well, because at 15% for dividend yield, it's amazing, and I really love the stock. If you are a risk taker, this is a great place for you to be. And this, with the dividend and the drip effect, you are in good hands. Now let's go see the institutional holdings. You know how we check some of the institutional, which institutions are holding the stock and what percentage are they holding, and I mean, are they buying or are they selling? Are these people, what are they doing with the stock? This is something that you also want to check always when it comes to buying a stock or researching a stock. So with institutional ownership, you always know that our safe place is 50 plus 1%. So normally 51% or 50 plus 1%. This is 31%, which is not too impressive. It's not something that I personally like, but I'll show you something that I think overrides that 31%. If you can see in the last quarter, what happened in the last quarter, look at what happened in the last quarter. BlackRock increased their position by 8%. Vanguard increased their position by 12%. Invesco increased their position by 46%. This guy's Mari Asset Global increased their position by 9%. Almost everybody increased their position by a higher percentage. Look at Morgan Stanley. Morgan Stanley increased their position by 424%. JP Morgan Chase increased their position by 58%. So you can see that these people are slowly increasing their position in this stock. You also see the dividend potential in there, because these guys will be making millions of dollars at the end of the year. 15%. Okay, because if you put $1 million in there at 15% at the end of the year, you'll be making 150,000. You're making 150,000. If you have $1 million in this stock, you'll be making 150,000 at the end of the year. So it kind of makes sense if you see all these institutional investors buying into it, because these people have a lot of money and they have a lot of firepower, so they'll be getting a lot of money back in dividends. And if they are reinvesting in their dividends back in this stock, then that's a lot of money. Or they can take all that money and reinvest it in another stock. So this stock makes a lot of sense, and I personally believe it's a good stock. Even if it doesn't move up, it doesn't go anywhere, and it bounces between $5 and $5.20, $5, $5.20. It bounces between that for the next 5 to 10 years at 15% a year. In the next let's say 4 year, you've already recovered 60% of your money and I've not even compounded it yet, because if I want to compound it by 4 or 5 years, you've already doubled your money that you put in here. Okay, that's when the drip effect starts taking place. So I think this stock is a good stock. It's a great rate, and if I didn't have any rate, I would look into this rate. If you don't have any rate and you're a risk taker and you want 15% dividends, this is something you should look at. Okay, this is for informational purposes only, and for educational purposes only. You buy it at your own risk. You know, I always have to say that. Anyways, like I always say, scared money don't make no money, and you always got to risk it to get the biscuit. I'm out of your hair. Stay blessed and stay safe. Peace.